Want to secure your financial future? Learn the top 5 investment strategies for beginners. Welcome to Rich Mindset 2006. Today we are going to discuss a prevalent issue that is very important to learn at an early age for a more secure financial future. These are the top 5 investment strategies for beginners. Investment refers to allocating resources, typically money, to generate future income or profit. It's essentially putting your money to work for you. But it is also a risky process that comes with potential losses and multiple fluctuations, so it is very important to learn various investment strategies and select the one that is more suitable for you depending on your comfort level and various other factors. In this video, we are mainly focusing on strategies for beginners and how they can begin investing. The major topics are passive index investing, dollar cost averaging, DCA, value investing, growth investing, and target date funds. So, let's begin. The very first strategy is passive index investing. This strategy focuses on buying and holding low-cost index funds that track a specific market index. These funds offer broad diversification across various companies and sectors, reducing risk compared to individual stock picking. Studies show index funds tend to outperform actively managed funds over the long term due to lower fees. For EG, index funds, exchange-traded funds. Some core principles to consider. 1. Track an index. You invest in funds that hold the same stocks as a chosen market index, in the same proportion. This provides broad diversification across various companies and sectors. 2. Low cost. Passive funds typically have lower expense ratios compared to actively managed funds. This is because there's no need for a team of analysts to constantly research and pick individual stocks. 3. Long-term approach. Passive investing is suited for a long-term horizon, 5+ years. Stock markets tend to trend upward over time, and passive investing allows you to capture this growth. What are the benefits? Diversification reduces risk by spreading your investment across different companies and industries. Lower fees saves money on investment management costs. Simplicity, easy to understand and manage, requiring minimal research compared to selecting individual stocks. Performance. Studies show passively managed index funds tend to outperform actively managed funds over extended periods. The second strategy is dollar cost averaging, DCA. This strategy involves investing a fixed amount of money into a chosen investment at regular intervals, like every month. This approach aims to average out the cost per share over time. By consistently investing, you buy more shares when prices are low and fewer when they're high. DCA helps reduce the impact of market volatility on your overall investment cost. These are the core concepts you should learn. Invest a set amount of money into an investment, stock, ETF, mutual fund, at consistent intervals, weekly, monthly, quarterly. Continue this practice over a long period, regardless of the current price of the investment. Let's look at some benefits of DCA. Reduced impact of market fluctuations. By buying at different price points, you average out the cost per share over time. You buy more shares when prices are low and fewer when prices are high, potentially lowering your overall investment cost. Emotional discipline. DCA helps remove emotions from the investment process. You are not trying to time the market by buying low and selling high, which can be difficult and stressful. Consistency. DCA promotes a consistent and disciplined approach to investing, making it easier to stick to your investment plan. The third strategy is value investing. This strategy involves buying stocks that appear to be undervalued by the market. Value investors research companies with strong fundamentals, earnings, financials, but whose stock price is lower than their perceived intrinsic value. The goal is to buy these stocks and hold them until the market recognizes their true value, leading to price appreciation. Value investing requires research and analysis but can offer good long-term returns. These are some core concepts you should learn. Undervaluation. Value investors seek stocks trading below their perceived intrinsic value. Intrinsic value represents the company's true worth based on factors like financials, assets, and future growth potential. Margin of safety. The difference between the market price and the intrinsic value is called the margin of safety. A wider margin of safety provides a buffer against potential miscalculations and downside risk. Long-term focus. Value investing is a long-term approach. The goal is to hold on to undervalued stocks until the market recognizes their true value, leading to price appreciation. Let's look at some benefits of value investing. Potential for high returns. Buying undervalued stocks offers the chance for significant capital appreciation if the market recognizes their true value. Margin of safety, a buffer against potential downside risk if the company's fundamentals are strong. Focus on fundamentals. Value investing emphasizes strong underlying company financials and long-term potential, promoting a more disciplined approach. The fourth strategy is growth investing. This strategy focuses on investing in companies with high growth potential. Growth companies may reinvest most of their profits back into the business for expansion, leading to a potential increase in stock price. This approach can offer significant returns but also carries higher risk as growth isn't guaranteed. Growth stocks can be more volatile than value stocks. These are some core concepts you should learn. High growth potential. Growth investors seek companies with the potential to significantly outperform the overall market. These companies may be reinvesting most of their profits back into the business to fuel future growth. Strong fundamentals. While future growth is essential, growth investors often look for companies with solid underlying financials like increasing revenue and earnings. Long-term vision. While some growth stocks might be suitable for shorter-term gains, this strategy generally has a long-term perspective, allowing companies time to achieve their full growth potential. Let's look at some benefits of growth investing. High potential returns. Companies with high growth potential offer the chance for significant capital appreciation as their stock price reflects their expanding market share or industry dominance. Investing in innovation. Growth investors can be at the forefront of technological advancements and disruptive businesses by investing in early-stage companies. The fifth strategy is target date funds. These are mutual funds designed for retirement savings. The asset allocation, mix of stocks, bonds, and other investments, automatically adjusts over time, becoming more conservative as you near your retirement date. This aims to balance risk and potential return based on your age and retirement timeframe. Target date funds are a simple way to save for retirement but may have higher fees compared to index funds. These are some core concepts you should learn. Age-based asset allocation. These funds are designed for a specific retirement target date, e.g., 2030-2045. The asset allocation, mix of stocks, bonds, and other investments, automatically adjusts as you get closer to your retirement date. Gradual shift to conservative. Generally, the asset allocation starts with a higher percentage of stocks, growth-oriented, and gradually shifts towards a more conservative mix with a higher percentage of bonds, income-oriented, as you near retirement. This aims to balance risk and potential return based on your age and nearing retirement date. Let's look at some benefits of target date funds. Simplicity and convenience. Target date funds are a one-stop shop for retirement savings. You choose a fund with a target date close to your estimated retirement year, and the fund manages the asset allocation for you. Diversification. These funds hold a variety of investments across different asset classes, reducing risk compared to picking individual stocks or bonds. Automatic rebalancing. The fund rebalances periodically to maintain the target asset allocation, ensuring your portfolio stays on track with your retirement goals. These are some of the strategies that you could follow according to your needs. For more such informative videos, subscribe to our channel. Like, share, and comment down below which strategy you like the most. Thank you.